Imagine the Indian startup world, full of unicorns and billion-dollar funding. But behind the scenes, many startups quietly shut down. In fact, over 90% of the Indian startup closed within 5 years. Government data shows that thousands of startups shut down recently. For example, 15,921 startups closed in 2023 and 12,717 startups in 2024. We studied dozens of these failed startups to find the patterns. So in this video, I'm gonna explain the most common problems like product market fit, spending competitions, team issues, etc. And I'm gonna share some real startup stories with their journey, funding, failure, and key lessons. So, as I said, in this video, we're gonna discuss about the common reasons why startup fail in India. So, without getting any delay, let's dive right in. The first topic gonna be the lack of product market fit. Many startups build products or services without solving a real problem. One survey found that not understanding what the market needs was a reason for 42% of failures among startups. TICE News said that Indian founders often build first and ask questions later, which leads to the products that investors like but customers don't really want to. If people don't need your product, then your business can't grow. So, for example, SchoolGennie, an edtech software, ran between 2013 to 2014. SchoolGennie was an educational technology startup from 2013. It aimed to help schools to manage their operations with one software. The founders did not raise outside funding, but they soon found that schools and teachers were not interested in this concept. So they shut down in 2014 after realizing that there was no real demand and they did not have enough experience in this educational space. So according to this failure, the founders were not familiar with how the schools worked and did not test the product with users first. They spent more money on fancy furnitures instead of hiring developers. As a result of this, their product never got off the ground. So the lesson we learned from SchoolGennie shows that if no one needs your product or will pay for it, your startup will fail. Even with a good idea, inexperience and poor planning can ruin everything. So the second reason for the failure of startup gonna be cash burn or spending too much too fast. Even with the good ideas, many startups fail because they spend too much money too quickly. In many industries like food delivery and e-commerce companies gave big discounts and spent heavily on marketing to grow fast. For example, TechCrunch reported that food delivery startups lost money because delivery and delivery costs were more than what they earned. A 2025 report said that high marketing costs and the fast expansion drained funds without profits. Investor money runs out too quickly. For example, PepperTap, a grocery delivery, ran between 2014 to 2016 years. PepperTap started in 2014 offering 2-hour grocery delivery through local store. It raised $51.2 million in less than a year as funding. By 2015, it was working in 25 cities and with 2,500 employees and was doing about 20,000 orders per day. It was successful, but its business model didn't work. In April 2016, PepperTap shut down grocery deliveries due to high losses. The founders said that they were drowning in losses. They gave big discounts up to 50% and free delivery but made only 20% commission from the sale. They lost about 130 rupees per day, which means 2,000 orders per day caused a loss of 26 lakhs daily. With growing competition from Grofers, Big Basket and Zomato, PepperTap couldn't keep up. It also expanded to small cities too fast in early 2016. They shut down operation in 10 cities and laid off staffs. The founder of PepperTap, founder Navneet Singh, said they had grown too quickly without building a stable business. Lesson we have learned from PepperTap shows how spending too much and growing too fast without profit can destroy a startup. Big funding does not help if your basic business is losing money. The third reason for the failure of startups in India is too much competition. In India, markets can get crowded very fast. For example, over 400 food ordering startups launched in a few years, leading to price wars and job cuts. In travel and hotel booking, companies like Make My Trip and Oyo made it hard for new startups. If you don't have something unique or better funding, you can be pushed out quickly. For example, TinyOwl, a food delivery platform, ran between 2013 to 2016. TinyOwl launched in 2013, as I said, to let people order food online. It raised over $27 million as a funding and operated in 11 cities and listed 4,000 restaurants. But it faced a heavy competition from Zomato and Foodpanda. Like PepperTap, TinyOwl gave huge discounts to attract users. It also hired too many people around 1,100 cities. When income didn't grow fast enough, they had to lay off many staff. By May 2016, TinyOwl was only active in Mumbai. Some co-founders were even detained by angry former employees. In the end, TinyOwl merged with Roadrunner in an all-stock deal. So the lesson we have learned from TinyOwl's story shows that growing before market profits and facing big competitions is very risky. Hiring too fast and giving discounts without a plan can lead to a shutdown. So the fourth reason for the failure of startups is gonna be external shocks or government rules. Some startups fail because of the external reasons like sudden changes in rules or major events. For example, RBI's 2018 ban on crypto banking made it hard for crypto companies to survive. The COVID-19 pandemic also hit transport and logistics startups hard. These sudden events can kill even growing companies. For example, Shuttl, a bus transit app, ran between 2015 to 2021. Shuttl was a bus sharing app for office commuters. It raised around $120 million as a funding, but during the COVID-19 lockdown, people stopped commuting. By mid-2021, Shuttl shut down as most people worked from home. They laid off staffs and merged with another company to survive. The lesson we have learned from Shuttl shows that even well-funded startups can fail when big events hit the market. Startups need to plan for tough times and be ready to adapt. Another example for the fourth reason for the failure of startup gonna be the Zebpay and CoinEx. Crypto exchanges 2017 to 2019 is this business model. Zebpay and CoinEx were big names in crypto trading. But in April 2018, the RBI banned banks from working with the crypto, which broke their businesses. Zebpay shut down in September 2018 and CoinEx stopped trading in June 2019. The lesson we have learned from Zebpay and CoinEx is rules can suddenly change and shut down startups. In risky industries, founders must be extra careful about government policies. So the fifth reason for the failure of startup is team and leadership problems. Sometimes inexperienced or misaligned teams lead to failure. Many failed startups had problems like poor decisions, team fights, or founders who weren't ready. Even with a good idea, a weak team can ruin the execution. For this reason, we have an example against SchoolGennie. The founders did not have experience in the education field. They spent money poorly like on office furniture and did not hire the right developers. As a result, their product never got built properly. The lesson we have learned from SchoolGennie shows that it's not just the idea, but the people behind it that matter. A strong, focused team is critical to success. So the sixth reason for the failure of startup gonna be growing too fast without a strong base. Many startups failed because they wanted to grow quickly without fixing the basic problems. They moved into new cities or launched new products before making their main business profitable. Founder later said they chased numbers like user count instead of building a strong basics. The best advice is to first make your core business work well, then expand. So the best advice is to first make your core business work well, then expand. For example, StayZilla, a homestay booking platform, ran between 2005 to 2017. StayZilla started in 2005 and later became a homestay platform. It raised over $34 million as funding and listed 15,000 stays and spent 56 crore on marketing in FY16. But revenue was low, 13.8 crore exactly, and losses were huge, like 94.5 crore. Each booking cost them more money than it earned. By early 2017, they had run out of funds and closed operations. The founder was even arrested due to the legal dispute with the vendor. So the lesson we have learned from StayZilla shows that big marketing and fast growth don't help if your business is losing money. Even large funding won't save you if your model is broken. So as I said before, I have researched over 50 failed startups and a few common patterns stand out is product market mismatch, cash burn or spending too much too fast, too much competition, team and leadership problems, external shocks or government rules, growing too fast without a strong base. So these failed startups teach us something important. Having a good idea and funding is not enough. Many companies failed because they built a product people don't want, or spent too much without making profits or grew too fast. So, for the future founders and investors, the lesson is clear. Focus on solving real problems, test your idea yearly, and keep a close watch on spending. Hype may fade out, but a strong business model and a real customer demand will always win. India still have bigger opportunities for those who learn from the past mistakes and build a smart and working plan from day one.